This morning, the Middle East exploded into escalation. Strikes were launched, missiles and drones followed, and global markets reacted instantly. Not tomorrow, not next week, right now. Today we're breaking down what this means for oil, gas prices, your investments, and how the system actually prices war. Overnight, coordinated strikes hit Iranian military targets. Iran responded quickly with missile and drone launches across the region. Airspace disruptions began. Shipping routes are being reassessed, and traders immediately began repricing risk. This is no longer tension, this is active escalation, and markets treat that differently because markets don't wait for certainty, they move on probability. Here's the key. Roughly 20% of global oil flows through the Strait of Hormuz. When conflict threatens that corridor, oil futures spike even if no barrel has been physically lost. Why? Because supply risk equals higher price premium. If crude jumps $10 to $20 per barrel, refiners pay more, distributors pay more, gas stations raise prices. Retail gas usually lags slightly, but it follows crude. If escalation continues, expect pressure at the pump. Energy is the base input of the global economy. When it moves, everything feels it. Markets hate uncertainty more than bad news. So here's what we're seeing. Winners, oil producers, defense stocks, gold. Losers, airlines, travel, consumer discretionary, rate-sensitive growth stocks if inflation fears rise. This isn't emotional trading, it's mechanical. Higher energy costs reduce margins. Higher volatility raises the equity risk premium. Higher risk premium lowers valuations. Money rotates fast. Here's what most people miss. Modern war is financialized. Capital moves instantly into US Treasuries, the dollar, gold. Why? Because global finance runs on liquidity hierarchies. When uncertainty rises, capital concentrates in reserve assets. At the same time, rising oil feeds inflation expectations. If inflation expectations rise, central banks hesitate to cut rates. So, one regional conflict can ripple into monetary policy expectations. That's systemic linkage. Oil isn't just a commodity, it's leverage. The Strait of Hormuz isn't just geography, it's a pressure point in global capitalism. When that pressure point is threatened, markets immediately reprice power. Not because supply is gone, but because vulnerability is exposed. Conflict equals risk premium. Risk premium equals higher prices. Higher prices equals tighter financial conditions. Geopolitics feeds directly into asset pricing. That's how the system works. If escalation continues, expect oil volatility, expect gas pressure, expect continued sector rotation. If de-escalation happens, some of this retraces. But right now, markets are trading probability, not outcomes, and probability just shifted. If you want more breakdowns of how power, money, and markets intersect, subscribe. This is where we decode the system.